the market was reacting. And you can tell right now, if you look at the market, kind of get a sense of where it's at right now, that we've come up to this top edge here, top of the range. We're starting to falter a little bit. I don't have the exact price today, but we can know that this is a potentially turning point to the downside to stay within that range. My preferred style of trading, if I'm setting up my trading plan, is I like to be a trend follower, and I like to trade on breakout types of situations where things change. That means that in this case, normally what you'd like to see, if the market goes up, you'd like to see it break down and have a downtrend, or vice versa. But sometimes the market doesn't always do exactly what I would like it to do. So you kind of got to go with what you've got. The other indicators that we have on this chart, we look at them and just get some other clues from them. The first one we'll look at here is the Neuro Index. The Neuro Index is that gray line. It compares two 3-day moving averages, a predicted moving average versus an actual moving average of typical prices, which is the average of the high, the low, and the close. And then it forecasts what the market will be in 2 days versus where it is today. If the indicator suggests it will be higher, then the reading is 1. If it suggests the typical price will be lower, then the reading will be 0. Bullish or bearish, there's not a lot between, but it's a good short-term indicator, particularly for getting into or out of the markets. And you can kind of see a little sense here in the recent couple of days here, where it chops back and forth, which indicates, as it does up above, a little bit of the indecisiveness of the market and trying to determine where it's going to go. The other indicator on here are the predicted difference lines. The predicted differences are the blue and the green lines that you see here. They are comparisons of predicted and actual moving averages. The medium term is the blue line. The long-term comparison of moving averages is the green line. And when you look at these, that's kind of a momentum indicator. As you can see, when the market starts to pick up and move up a little sharply and it widens here, you can see that this blue line is widening. It's a momentum indicator. You'd expect that shorter average to move more quickly than the longer average. But then, as this blue line starts to sag back down towards the actual moving average, you can see what happens here to the predicted differences. They start to roll over, start to turn down. We have a crossover here, which is an early alert that there could be a change in momentum that would affect the strength of the trend that you have on the chart. Necessarily a absolute trading signal, but it's a good early alert that something may be afoot, something may be ready to happen. One of the things when we look at this particular indicator that is also helpful when you see what we have on here is that we've only showed the last few months, but when you look back for the whole, we'll go back to a whole year on this, you can see, if you can see where that horizontal line is there, when the market gets up to about plus 20, it tends to be, act like an overbought type of a indicator, like the stochastics and some of the others, or below minus 20, oversold. So when it reaches that, it doesn't guarantee it. As you can see, that big slump that we had in March, there's no limit on how high, how low it can go. But when it reaches there, that's another sign that there may be, something in the wind that would suggest it won't push that much further, especially as it comes up to a previous high where there's a battle zone going on. So I need to prepare my trading plan with that in mind, keeping the factor in mind that, maybe I really won't be able to, trade my preferred trend following style, just because I think that's where it should go. Maybe the market doesn't think that way it should go. So we're going to cut back our time frame. We're going to go all the way back here to only a 1-month chart, because we want to talk about, precisely how my trading plan is going to work and what I'm going to do at given points to get into a market. Now, I have to step back a little bit from the current time to explain a little bit how I got into the market and what I would do. I'm going to start right here. When we look at this chart, this is only the last month. We're going to start with the October 4 trade date here. That candle that you can see there, which was a nice little kind of a turning point candle there. And when I look at that candle, it's kind of a key date, and you can talk about that's the low of the range. we've come down to the low, the market, and when it hits that low, if it makes a breakout, potentially trend following type of trade to take it lower. But if it doesn't, hits that line, bounces back, we could be in a counter trend type of situation. Now, I'm not adverse to taking either one of those, but as I said, my style of trading, my plan would include more of a trend following thing. Now, there is another way that you could trade this, and we need to talk about the possibility that maybe your inclination is to be a day trader. So we're going to add another couple of indicators on here. We're going to add Vantage Point's predicted high and predicted low to the mix, and we're going to talk about how that could potentially be the signpost that you need for determining where you're going to take a position. The predicted high and the predicted low, that's forecast for 1 day ahead, and you can see that in this particular case, when the market dips down here, first I should explain this is a predicted high, that gold line, and the predicted low is that pink line that you see there, forecast 1 day ahead. You can see how it has forecast the range for today. That's why that line looks a little different. Doesn't mean that's what the prices have done, but that's just kind of the forecast of the range for today. But looking at this October 4th date, we came in here, one would like to think that when it gets down towards the bottom, if you're a range trader, or a lot of the commercial traders or professional traders will be, like they do with pivot points or some other things, they will trade on the assumption that it's going to bounce off some support and move higher. At least that's the initial action. In this case here, if you were of a day trader bent, and that's, again, I said not me, but if you were of a day trader bent, you might think, okay, we are approaching a low. What we're going to do is we're going to let the market, establish it's kind of a low point for today. Maybe it's going to move into a trend following strategy, but maybe not. It turns around, goes back up, and we will trade long. We'll go long when it moves back up above the open for the day. Kind of like the oops type trade that, the market goes the wrong way and then oops, makes them realize it made a mistake and then goes back up. Potential long position that could have been established right there on a short-term basis. But as I said, in this particular case here, the predicted low was at 1073, and then you could potentially, if you did this type of strategy, got on board at the open at around 1088. Now, as I said, that's not really my style, my plan, but I like to look at it from more of a trend following type perspective. So I'm going to get rid of the day trade type of a thing. This might work for you, but not necessarily for me. As a trend follower type of approach, I want to set up my plan so that I'm going to use the average daily range as a point of reference here. In the average daily range, you can see some of those candles are looking pretty big, and it may vary over time, but the current average daily range that I am using to set up my plan is going to be 40 points. That is, if the market moves 40 points above the predicted high, this predicted high right here, then I am going to be a buyer. If it goes 40 points below the predicted low, then I'm going to be a seller. You will see there are some points in here where you get into this situation. You probably may not have attempted to be a trend trader in this position because you're still pretty much in the middle of this particular range. If you're a trend trader, you want to wait for the big break here because that's where the trends are going to come. The choppy action in here, you might make it. It might be a good trade. It might not be a good trade. So